Cryptocurrencies have become a hot topic in the world of finance, with many investors and traders looking to profit from the digital assets. However, the crypto market is also a breeding ground for scams and frauds, with many unscrupulous actors preying on unsuspecting victims. In this article, we'll explore the dark side of cryptocurrencies and the risks and scams that you need to avoid. Phishing and hacking. One of the most common risks in the crypto market is phishing and hacking. Cybercriminals use various tactics to trick users into giving away their private keys or login credentials, such as fake websites, emails, and social media posts. Once they have access to your crypto wallet or exchange account, they can steal your funds and disappear. To avoid phishing and hacking, you should always use strong passwords, enable two-factor authentication, and double-check the URLs and email addresses before clicking on any links. Ponzi schemes and hypes. Ponzi schemes and high-yield investment programs, HIPs, are another common type of crypto scam. They promise high returns on investment with little or no risk, but in reality, they are unsustainable and fraudulent. The scammers use the funds from new investors to pay off the earlier investors, and when the scheme collapses, the majority of investors lose their money. To avoid Ponzi schemes and HIPs, you should always do your research, check the credibility of the project and the team behind it, and never invest more than you can afford to lose. ICO scams. Initial coin offerings, ICOs, are a popular way for crypto startups to raise funds by selling their tokens to investors. However, many ICOs turn out to be scams, with no real product or use case behind them. The scammers use flashy marketing and hype to attract investors, but once they collect the funds, they disappear or abandon the project. To avoid ICO scams, you should always read the white paper and the project roadmap carefully. Check the credibility of the team and advisors, and evaluate the market demand and competition for the project. Pump and dump schemes. Pump and dump schemes are a type of market manipulation where a group of investors artificially inflate the price of a low-volume crypto asset and then sell their holdings at a profit, causing the price to crash. The scammers use social media, chat rooms, and other platforms to coordinate their actions and lure unsuspecting investors. To avoid pump and dump schemes, you should always do your own research and analysis, and never follow blindly the advice or recommendations of others. Exit scams. Finally, exit scams are a type of fraud where the founders or operators of a crypto project disappear with the funds raised from investors. They may use fake identities or offshore companies to hide their tracks, making it difficult or impossible for investors to recover their funds. To avoid exit scams, you should always check the credibility and reputation of the project and the team behind it, and never invest more than you can afford to lose. The dark side of cryptocurrencies is a real and ongoing threat, and investors and traders need to be aware of the risks and scams that they may encounter. By staying informed and vigilant, you can protect yourself and your investments from the unscrupulous actors in the market. Remember, if something seems too good to be true, it probably is. And if you're in doubt, always seek professional advice.